I began investing when I was just 11 years old. Before that, I often hesitated despite my early interest in money. At 11, I bought my first stock and was instantly captivated by the world of business. I experimented with different ideas, timing the market, studying charts, and testing out unusual strategies. Even though I didn't earn much at first, it was fun, exciting, and a real crash course in how stocks work. I continued these experiments until I was 19, learning valuable lessons along the way. During those early years, I read every book about investing that I could find at the public library. I absorbed all the information with great enthusiasm. Even though I did not yet have a clear plan, I was searching for a simple explanation that could make sense of the numbers and graphs I saw on the pages. I hoped that these little details would reveal what a stock might do in the future. Although many of my peers were trying similar things, I soon realized that there was more to investing than just following charts. My early experiments laid the groundwork for a more thoughtful approach that would come later in my life. In 1949, I read a book called The Intelligent Investor by Ben Graham. Until that moment, I had not heard of him, but his ideas completely changed my perspective on investing. In that book, I found two key chapters that set out a simple way of thinking about money and stocks. The first major lesson I learned was that a stock is not just a ticker symbol or a number. It represents a share of a real business. When you buy a stock, you are buying a part of that company. To decide whether a stock is a good buy, you need to understand the company's overall value. This means looking at the business as a whole and dividing its value by the number of shares available. More importantly, you must ask yourself what kind of business you are investing in. Consider the company's strengths, its competition, and how well it is managed. As a young investor, I used to recognize companies only by their short symbols. Without understanding what lay behind them, I soon realized that to be successful, I had to look beyond the numbers and learn what really made a business valuable. The second lesson from Ben Graham's book introduced me to the idea of Mr. Market. Mr. Market is a fictional character who visits every day, offering to buy or sell stocks at different prices. His offers can be very unpredictable, and his mood swings can be extreme. One day, he might offer a high price because he is feeling optimistic, and on another day, he might offer a low price because he is feeling pessimistic. Many investors become too focused on these daily price changes and let their emotions take over. They feel happy when their stocks rise and sad when they fall, mistakenly believing that these fluctuations tell them what to do. However, Mr. Market's daily mood is not a guide for your decisions. Instead, you should only pay attention to his offers when they give you an advantage. You are not required to follow his every word or react to every change. The important point is that you can choose the best time to act, using his unpredictable offers to benefit yourself. This idea helped me learn that successful investing is not about reacting to every market movement, but about waiting patiently for the right opportunity. Another key idea I learned is the margin of safety. Imagine driving a heavy truck over a bridge with a weight limit. If your truck is too heavy, you'll risk an accident. In investing, this means you should only buy a company's stock when its price is well below its true worth. This safety gap protects you from mistakes or unforeseen events. Instead of focusing on the current market price, study the company's financial reports to understand its real value. In short, always leave room for error in your investments. This approach helps you avoid big losses and ensures you invest in solid, well-founded businesses. These three simple ideas, thinking of a stock as part of a business, using Mr. Market's offers to your advantage, and investing with a margin of safety, became the foundation of my investing style. I realized that you cannot ignore any one of these ideas and still be a good investor. They work together like the legs of a stool. Without one, the whole stool would collapse. Over time, I learned that the most important thing, especially when handling large amounts of money, is to truly understand the business in which you are investing. Imagine being given $1 million to invest in private businesses, not stocks that you can easily trade. You have 1 week to decide where to put your money. During that week, you would carefully study many companies, looking at their reputation, management, and competitive strength. You would seek out businesses with a lasting edge, a quality that keeps them ahead of rivals over time. Think of that advantage as a castle with a deep moat protecting it. In any competitive market, companies face challenges from competitors who want to copy their success. To stay ahead, a company must build strong defenses, whether through unique products, exclusive rights, or a powerful brand. For example, a well-known beverage company company has built a strong image in the minds of millions, and that positive reputation acts as a barrier to competitors. The best companies are also led by honest, capable managers who make smart decisions. Some experts even suggest that a business should be simple enough for someone with little experience to run successfully. From my own experience, I learned that focusing on companies with a clear, enduring advantage and strong leadership is key to building a successful investment portfolio. It's not about chasing every new trend or making impulsive choices based on short-term excitement. Instead, it's about choosing quality businesses, studying them carefully, and patiently letting them grow over time. To sum up, my early experiments in investing taught me many valuable lessons. I learned that a stock is a share of a real business, and that understanding the business is much more important than simply following its price movements. The concept of Mr. Market taught me to ignore daily fluctuations and only act when the market offers a real advantage. The idea of a margin of safety helped me understand the importance of investing at a price well below a company's true value. And finally, focusing on long-term quality investments, those with a lasting competitive advantage and strong leadership, has been the cornerstone of my investing success. Even though the world of investing can seem complicated with its numbers and charts, the basic ideas remain simple. With patience, careful study, and a focus on real value, you can build a stable and secure investment portfolio. Remember, the key is not to react to every change in the market, but to make thoughtful decisions based on sound principles. Always take the time to study the businesses behind the stocks, and do not let short-term emotions cloud your judgment. In the end, a careful and steady approach will help you grow your investments over time and achieve lasting financial success. Like and subscribe if you enjoyed this message and want to learn more about simple investing ideas. In addition to these lessons, remember that continuous learning is key to investing. The market constantly changes, so keep reading, studying, and updating your knowledge about businesses and the economy. Even after building a strong portfolio, always learn from every gain or loss. To improve your strategy, stay curious and open to new ideas, and use setbacks as opportunities to grow. Patience, discipline, and a commitment to lifelong learning will help you adapt and achieve lasting financial security.